Good afternoon, everyone again. Jean-Marc, the CEO at JMS Invest, is going to deliver the next presentation. JMS is a Swiss asset management company which has achieved outstanding results. Outstanding results. We were very impressed when we first read their presentations. They've managed to achieve equity, they've managed to outperform the European benchmark. They are experts in European equities, and they've managed to outperform with only 29% net exposure to European equities. So they have a long-short portfolio. They have also decades of experience in the market. They follow a fundamental approach with a bottom-up approach, and he will explain their approach, what they do, and what investors can expect. Thank you.
Thank you very much, Javier. I think I should hire you as a salesperson. You do the better job than I will do, probably. But I would like to thank Tenvalue for hosting this event, and I would like to thank you for your interest in JMS Invest. As you said, my name is Jean-Marc Müller. I'm the CEO of JMS, and I will walk you through the presentation. What can I say about JMS Invest? I think it was Larry Fink who said, asset management should be boring. Boring is good. And I think from an investor point of view, that is right. We should have steady returns, low volatility, no drama. However, for us working in the industry, I think it should be exactly the opposite. I think it should be fascinating, interesting, and exciting. And at least for us at JMS, I can say that we are super passionate about what we're doing. We are super passionate about our stocks, our portfolio, and all the opportunities and challenges that come our way. If you come and visit us, you will realize that the investment approach of the 4 portfolio managers is actually quite different. However, it is very complementary. And because of that, we managed to establish a very balanced portfolio. And then there's also ample expertise among the 4 of us. We started this 17 years ago, so shortly before the great financial crisis. Then we had Madoff, we had the flash crash, we had the Euro crisis, we had Fukushima, we had Corona, we had negative interest rates, we had inflation, we had a war in Europe. Everything the market threw at us, we mastered it. And obviously it goes without saying that as a shop here in Zurich, we are regulated by FINMA with all the necessary structures when it comes to risk and compliance. So what do? We manage a long-short equity fund, and I believe the secret sauce of our success is that we are very much focusing on a small niche. And the niche is the DACH region in Europe. This niche comprises of roughly 230 stocks, and it is our aim to know those 230 stocks better than anyone else. And how do we do that? It's through fundamental bottom-up approach. So we analyze those companies, we have our own models, we speak to the management teams of these companies, we speak to analysts, we benchmark our findings with consensus estimates and peers, we speak to friendly competitors. All this together should create a picture of a company better than anyone else has. And it is important to have this picture because when change happens within a company, we want to be the first one to realize. So we want to be quick to market and quick to execute. And it has served us quite well with an annualized return of roughly 7% per annum. I think we have shown that this approach works. And in that context, I shall also highlight the track record of 16 years. Now, the biggest advantage of a long track record is you don't have to justify your approach anymore, right? It works. Otherwise, we would not be in business. It's like a surgeon who has done a procedure a zillion times You just trust him that he can do the procedure one more time. And that is similar for us. And the track record, and I will speak about the performance a bit later on, is actually quite good. However, the most important part of this slide, in my view, is that we should speak about the alignment of interest. All the 4 people that I introduced to you very briefly on the other slide, all the liquid assets that they have are invested in our funds. We quite literally eat our own cooking. We live and breathe basically what we do, and we are dependent on the performance of these funds just as our investors are. I keep saying that your performance is our performance, and I believe that is how it should be. Now, quickly on the performance. The green line is Alpha Core 1, the fund we manage since a bit more than 16 years. And yeah, it looks quite boring. Boring is good. I think the goal must be that we limit the major drawdowns, and if we have drawdowns, that we can recover as quickly as possible. I should highlight that we have outperformed relevant benchmarks such as the Eureka Hedge Europe Long Short, and also like a long only index, a benchmark index like the Stock 600. We have outperformed quite considerably. I should also note that these indices here, that they are in euros and dollars. Our performance is in Swiss francs. So if you were to actually FX adjust, the outperformance would be even more considerable. So how do we do that? The absolute performance in itself obviously doesn't say that much, right? You always have to see absolute performance in the context of the risk that you're taking. And this is actually one of my favorite slides because it shows that the performance we're achieving, we are not only outperforming benchmarks as we've seen on the other chart, we're also doing this with having much less volatility than actually peers or a long-only index. I mean, if you compare to the long-only index, the volatility, the risk profile of the fund is actually less than half of what a long-only index would suggest. And this then leads to very solid ratios, just as Sharpe and Sortino. And in all fairness, this is the reason why we keep winning awards, because those institutions that benchmark us with other funds, they look exactly at risk-adjusted returns as their main metrics number. One investor once told me, you know, these numbers kind of can compare like this. If this was like Volkswagen, let's say, when you buy AlphaCore, when you invest with AlphaCore, you get the Mercedes, but it actually uses half as much gasoline as a Polo would from Volkswagen. And I think this little anecdote kind of highlights quite well what we do. It is a very conservative product, but still produce quite solid, outstanding results. Now, why is the volatility so low? And I kindly, shortly describe this here. It is mainly coming from very low exposure levels. So the gross exposure is around 100%, and the net exposure is around 28 to 30%. I think since inception, it was around 28%. And these low exposure levels obviously lead to quite a lower volatility of the product itself. Now, you might wonder, but if the beta aspect of the fund is so low, why is performance so good? It's simply what we call alpha. I looked at the numbers since inception, and we managed to capture roughly 4% alpha per year on an annualized basis per year of alpha since inception. So out of this CAGR of nearly 7%, actually 4% is coming basically from our hard work. what I described, analyzing the companies, doing the legwork, the bread and butter business, trying to find hidden gems before everyone else does. This brings the 4% alpha, and on top of that, we have the beta component coming from a small net exposure of around 30%. That then comes on top. But obviously all this with very low volatility. Now, why do I believe that it is an interesting time now to look at a product like this? And I think the next chart is quite telling in that sense. This is the underperformance of small caps versus large caps in Europe. So you see that basically small caps have outperformed over time, and that makes sense because the risk profile of a small cap is much higher than of a large cap. Obviously, the return profile also should be better. So we should see some outperformance of small caps versus large caps. However, there are always times when large caps underperform, small caps underperform. Sorry, this is during the great financial crisis. We had a substantial underperformance, which was then recovered in the years to come, and then basically the small caps went back onto the trend rate that we had. Now, since roughly 3 years, we see a similar underperformance of small caps versus large caps. It has also, in terms of underperformance, quite similar to what we've seen here. And we believe that eventually there is a trend reversal trade here to happen. And if we were just to go back to the level where we were around summer of 2021, this would already imply an outperformance of small caps of around 30%. So, very simplified, if this was to happen over 5 years, we are talking about a tailwind of roughly 5-6% or so per annum, which then supports our strategy. So we would probably be able to even achieve better CAGR numbers than we have in the last couple of years because we get the tailwind from a potential small cap rally. Now, obviously, when this is exactly happening, we don't know, but we are very confident that it will happen, and we are excited for that opportunity because we then really want to fully capture on it. So, in summary, what have we done? So I think we have shown that we have a successful strategy, that we have been around for 16 years, which is not obvious. I mean, it's not so easy to find that many peers with such a track record. It's an award-winning track record. I think we have proven that the strategy works with a lot of downside protection. It's quite a boring strategy, but I believe that steady returns are to be favored compared to volatility. We have compounding returns in all market environments, and obviously, but I mean this goes without saying, I think we have a very good structure here in Zurich, being FINMA regulated, and the funds, they are based in Ireland, they are all under the UCITS structure regulated by the CBI. And again, I would like to highlight that we live from what you live. Our cooking is your cooking, my performance is your performance. I think it's very relevant to understand that. With that, I would like to close, and if there are questions, I will be more than happy to answer them.
Are there some questions? Yeah, I see some hands raised here first. Gustavo?
Yes, you talk about long-short pair trading basically. How do you assess? Do you have to go deep into those two companies you're gonna put against each other in pair trading, or are more I wouldn't say top down, but are more, what's the word for that?
It's actually we do not only do pair trading, right? So the long book really comprises of the stocks that we like, you know, investment cases. We have research for many years, companies we've known for many years, management teams we've known for many years. This is also not a very trading-oriented fund. If we like a story and the investment case works, we can stay invested actually for many years. The short book, which is the red line here, the short book comprises of three elements. One is outright shorts. So just things we don't like, right? Companies where we believe they will underperform the market, where we actually believe that regardless whether markets go up or down, we can actually achieve alpha just by being short that name. Then there is a component where we do kind of match longs with some shorts. It can be an individual short, but it can also be kind of a subsector. The easiest example is I like Elmos, which is a semiconductor company in the automotive industry. I am short the stock 600 automotive against this long trade. And the third one is, and this has more to do like with factor modeling, etc. The biggest risk we have as a fund is our exposure in small caps. And it's very difficult to short that factor, to limit that factor risk, because you cannot just short a basket of small stocks. You don't get the lending, etc. And to limit the risk there, we work together with Morgan Stanley, and they look at our portfolio and they actually put together a basket for us. And this basket consists of small cap stocks, and we basically only have to short the basket, so not all the individual stocks that are in the basket. Morgan Stanley then is doing that for us. And that limits our kind of factor risk small cap. And this has worked very well. I mean, in the past, we were short stocks Europe small, the smallest 200 stocks of the stock 600. But compared to what we are long, these are still kind of fairly large companies. And there was always a mismatch. And with the new basket now from Morgan, I mean new, but it's a couple of years now, this effect has worked much better.
Jean-Pascal, there are two more questions. If you can
Sure.
please reply in around a minute, just for
Sure.
for
Short
time
answers, yes.
thing, yeah. And this one, Arthur, you can ask.
Hi.
Thank you.
You show sort of the average performance annualized over a large period of time.
Yeah.
How consistent has it been over the years in terms of how sort of uniformly distributed? You know, in some cases, there are funds that perform quite well at the beginning when they're smaller.
Yeah.
And they, over time become more average, but annualized over the years, it looks good. How
Yeah.
is this in your case?
I agree. I mean, this is now since inception, and it's fair to say that here, especially at the beginning, especially also the relative performance has been much better because we did very well, during the financial crisis. It's also fair to say that as a hedge fund product, with a lot of cash, basically, because we only net 28%, so we carry a lot of cash, that the phase with negative interest rates was not helping. And we already see quite now a difference here since interest rates have come back, that the outperformance, I mean, this delta of negative interest rates to positive interest rates is obviously helping overall performance. The alpha contribution actually can be quite wild, so I would not say that in the beginning alpha was much better than later on. And for example, this year we have a very good year with, in Swiss francs, we're up nearly 9%. And the alpha contribution is actually super solid because S stocks, M stocks, they're all negative, right? So the alpha contribution is very high.
Thank you. Thank you for the question too. The last question? Yeah.
If it's working so well, why only DACH?
So two quick answers to that. Why did we choose DACH? We chose DACH because we felt at the time typically quite a good sample of companies, innovative companies, we felt that actually management teams quite good in general, right? Disclosure quite good, governance quite good. So we felt that altogether this is already a good sample of stocks to have. And then we also felt that there is a language advantage when you can, because we speak a lot with the analysts, the management teams, etc. So if you can speak in the home local language, I think that gives you an edge. And I think it works. However, we also feel that the approach is working in different markets. And this is why we have set up a second fund, which I did now not really present because it only has like 2.5 year track record now. It's called Time Horizon, and there we actually take a pan-European approach. So this is the idea that we can grow as an asset manager, can grow the assets even more because there are some capacity constraints when you deal in small caps, you know, liquidity, etc. is not good. So this cannot be much bigger than 200, 250 million maybe. And the other fund being pan-European and a bit broader in scale, we could then actually manage more assets. But thank you very much for your time.